shift focus to IT, and within that IT basket, what we really noticed was the fact that some extraordinary items seem to have brought the profit after tax number well below estimates, despite the companies delivering a decent EBIT number and even better EBIT margin than the consensus estimates. To understand this accounting angle better and to try and understand what the impact across the board could well be, not just Nifty but across the board, we have Charanjot Singh Nanda. I beg your pardon, sir, if I've got the name wrong. Charanjot Singh Nanda, the president of the ICAI, who's joining us. Sir, great having you here. First off,
Thank you.
Give us some color on what the accounting nuances are with regard to the new or the changed labor laws. This is Harsh here, sir, by the way. So first give us a sense of what this means from an accounting standpoint, and why account for all of it in Q3? Is there a provision where one can stagger it over maybe the next 4 quarters?
I would like to just give you a brief overview.
Sure.
The new labor code, which consolidates 29 existing labor laws into 4 comprehensive codes. So if you go ahead, you will see that largely if the wage is 100, if the salary is 100, your wages compulsorily have to be 50. And therefore, the gratuity amount payable will go up. And in this regard, the Accounting Standard Board of ICAI has issued a set of FAQs clarifying the key accounting implications arising from the implication of new labor codes in India. This is effective from 21st November 2025. The first issue which you said, that would there be prudent to stagger such expenses? No. The impact is as on today, as on 21st November 2025. Therefore, the increase in gratuity liability or other benefits arising out due to application of the new labor code is a past service cost as a result of changes in the benefit payable under the plan, and therefore it has to be accounted in accordance with the applicable accounting standards, which is AS 15 and Ind AS 19 of employee benefits.
Perfect. And therefore, this impact will be felt across corporates in this quarter itself. Will this basically be...
The only that if you are preparing quarterly accounts, you have to disclose it and you have to take the cognizance Q3. If it is not so, then you have to go for annual accounting, annual financial statements. The impact has to be shown. So it has to be in the current period only.
And would a tax deduction for this be available under the Income Tax Act, sir?
No. It is as applicable, which is going on, but nothing new on this account.
Understood. Okay. And talk to us about what this does going forward. Is there a ballpark percentage of employee costs that one can try to extrapolate? Because, sir, we're linked to markets, so I'm trying to understand whether one can try and extrapolate this number in some fashion. Is it a percentage of the employee cost, or is it completely computed company-wise?
Basically want to understand about materiality.
That is correct.
That AS1 speaks of materiality. As per AS1, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary user of general purpose financial statement make on the basis of those financial statements. The meaning is that if that is omitted, there is no major impact. But this is up to the company to take a call. Materiality has to be taken by the company, and ICAI or accounting standard does not prescribe any quantitative thresholds for materiality.
Accounted for under extraordinary items, sir?
No, it is not an extraordinary. See, they may have said this, but in my opinion, it is not an extraordinary item because it is a liability which has arisen now. Although due to incidence of a regulatory compliance, it has now been created. So when it is created, it has to be accounted for.
I understand. This will also, Mr. Nanda, impact the numbers going forward? Because you will have to typically provide for a larger gratuity quantum, I understand, going forward as well. What would that component broadly be? Is it 1%, 2% of employee cost? Is there a back of the envelope maths that one would have done in terms of what the impact could be?
It is not possible to do so, Harji. There is no
Understood.
such benchmark, there is no such pointer where you could identify what is the percentage. That at the end of the period you can see, compare it with the previous year figures, but as of now you can't do it. And it will not be uniform across all the sections of the companies. It will be different from different companies.
I fully understand that. Right, Mr. Nanda. Mr. Nanda, any other nuances with regard to the labor code which one needs to keep in mind according to you?
I would just like to say that certain section of society is asking that if any restatement is required to be made in historic value or periods. So in this regard, I want to clarify that since the impact of new labor code is arising in the current year, restatements are not required in comparative figures. Also, entries preparing interim financial statements for the third quarter, I again repeat, this is a very important question on which we have received so many queries. Entities preparing interim financial statements for the third quarter are required to recognize the increased liability in the interim period. Other entities will show the cognizance in annual financial statements. Otherwise, you have to live with it. It is something which has been created. I understand that the impact on gratuity will be huge, but you have to take that to the company.
Excellent. Mr. Nanda, thank you so much. We've tried to obviously cover as much as possible, and we've also asked you a residual question. I hope that we've covered enough with regard to the labor code and all the
Very
clarifications that you wanted to make.
One thing at the conclusion, I'd like to say that we have the FAQs of ICAI ASB, Accounting Standard Board. Anybody can visit our ICAI.org and look at the FAQs. Thank you.
Yes, we have done so, Mr. Nanda. Thank you so much for joining us and giving us this clarity, sir.